Meet Kevin, a YouTuber. If you've probably heard of him, if you're watching this video, has his own ETF. If you've never heard of it, it's called the Pricing Power ETF. Meet Kevin Pricing Power ETF. Ticker symbol PP. Pretty funny. I'm sure he did that on purpose for the memes. Anyway, we're going to review this portfolio today, and I'm going to give my takes on it. Before we do any reviewing, let's just talk about the fund performance so far, okay? So we've got a year-to-date performance of 21.13 versus the S&P 9.17. So far doing good on a year-to-date situation. All right, let's get into this portfolio. But before that, thank you for being here. I'm Austin. I'm a co-owner of cloudmusicsuite.com, and I'm a stock market investor, of course. Thank you very much for subscribing. We're at 130-ish subscribers. So if you're one of those, thank you so much. If you're not one of those, go ahead and become one so that we can hit that 200 mark. My two cats, Millie and Luna. Millie's the gray one, Luna is the brown one. They thank you as well. Here's a picture as a thank you for subscribing. All right, let's go ahead and get into this. We're just gonna look at the top 10. I think there's about 19 stocks in here if I'm not mistaken, but we're just gonna look at the top 10 because that's the high majority of what you would be getting if you were to buy into this ETF. Starting at the bottom, actually, let's go ahead and look at number 10. The 10th biggest holding in this ETF is Bill.com. So Bill.com is a payment handler, okay? So they have a back-end infrastructure for payment handling, and I have wanted to look, I've looked into this company many times. I've wanted to buy this company many times, but I see a lot of risk here, and I don't think the risk is worth the potential return. When I look at something like Square or something like PayPal or even something like SoFi, I see a lot more potential upside with similar downside as Bill.com. Yes, it's been a great returner over the last few years. I personally don't know that much about the management team, so I can't speak on the management team, but I haven't liked the valuation like ever, so I've never personally invested in Bill.com. I have no issue with him holding this as the number 10 holding in his portfolio though. So I am all about this one. This one's looking pretty good. Less than $1 million in there, 3.32% of the portfolio. Next one up, actually I'm going to talk about the next three. Taiwan Semiconductor, ASML, and then Advanced Micro Devices. And one above that, NVIDIA, and above that, Enphase. These are all in some way, shape, or form attached to semiconductors. So the semiconductor industry is 5 of the, and there's actually one more that I'll talk about in a sec, 5 of the holdings inside of this. So Taiwan Semiconductor, I love the company. I personally have thought about opening a position with Taiwan Semiconductor. I love the company. I love the valuation. Of all the semiconductor plays, I think they're one of the top ones. I get a little worried about the Taiwan tensions with China and the US, but TSM is making a plant here in America, so that's pretty cool. I like that. 4.8% of the portfolio. To me, it makes no sense for him to have ASML and AMD and NVIDIA and Enphase all in this same one. Though Enphase is definitely the outlier of these, more in the solar area. They make these PV photovoltaics for solar. I like Enphase Energy. I really wanted to make an Enphase position back when the last time I thought it was undervalued, which is around $20, and it's way higher than that today. So it's been a great returner. I think Enphase is a great company with a great management team. I just don't like the valuation, so I have never stepped into Enphase. As it relates to NVIDIA, I feel very similarly. I did like the valuation about 4 months ago with NVIDIA. I didn't pull the trigger on NVIDIA shares, but he's got a 5.73% holding there. And then AMD, I also love AMD. I think AMD always trades way too expensive on a price to earnings ratio and a price to sales ratio. That said, they are a great company, so I can't hate on that. About 5% as well there. There is a pick in here that makes no sense to me, especially since they reported earnings today that I'm recording this video. So ERJ is a aerospace and defense company. They just reported earnings for their Q1 on the 5th of May, and it was an absolute disaster. They missed EPS by like 50 cents to the negative. Like it was supposed to be 1 cent positive or 1 cent negative, and it was around 50 cents negative EPS per share. Kind of scary. That's a disaster of a quarter there. Stock's down like 10% today. And then they've also got a big revenue miss today, like in the many millions of dollars revenue miss. I don't have the numbers in front of me right now, But yeah, ERJ, I don't understand this pick whatsoever at all. Someone like Northrop Grumman, someone like Lockheed Martin, it would have made a lot of sense to me. Even Raytheon would have made a lot of sense to me. This was a great pick over the last year or so with the Russia tensions and all that with the US. Russia, Ukraine, US, all that nastiness situation. These have been great stocks to be in, but like you got to pick the cream of the crop. You look like you picked the cream of the crop as it relates to the semiconductors, Taiwan Semiconductor, AMD, NVIDIA, Enphase. These guys are beasts. You didn't pick like the little guy in these, you know what I mean? So I don't know why we picked the little guy, ERJ, as it relates to the aerospace and defense. I would have liked to have seen, if we just swap this out with Lockheed Martin, I would be 2 thumbs up from me. NVIDIA, we already talked about that one. I love NVIDIA, I can't hate. Trade Desk. Also love Trade Desk. Great company. Once again, it's a valuation issue. I don't think Kevin even looks at valuation at all. I think he just says, oh, is it a good company? Cool, good. I'll buy it at any price no matter what because I have way too much money. Most people have a limited amount of money they can put in the market on a monthly basis, and they're a lot more picky about the pricing that they get. I think it's important to be picky about pricing. I have made a few mistakes where I wasn't picky about pricing. I bought Zillow stock at like $100. I thought, oh, Zillow's gonna be around forever. Yeah, well, even if Zillow's around forever doesn't mean $100 and the current price to sales and price to earnings and debt situation they had, it wasn't a good situation. I lost my butt on Zillow. So, you know, it's not always a good thing to just buy a stock because it's a great stock. You have to buy a stock because it's a great company and because the valuation's in a great spot. Anyway, 7.32%. I love the company, like I said, but valuation has never been there for me for a Trade Desk. I got really close when it was in the $40 range about 4 months ago, but I did not pull the trigger on Trade Desk because I still didn't think the valuation was very attractive. Okay, next one, we're at the top 2, Apple and Tesla. Apple, I feel like he's using this as a cash park, collect a little dividend along the way. Apple's one of the most stable companies in the world. Apple's the biggest company in the world by market cap. They're an amazing company, and they execute quarter in and quarter out. And even if they don't execute, they have a huge buyback plan where if their shares drop in a meaningful way, they're going to pick up shares. And you know who else is going to pick up shares? Warren Buffett, along with all of the whole Berkshire Hathaway Corporation, is also going to pick up more shares of Apple if Apple drops in a meaningful way. So they have a huge floor underneath them. It's hard for Apple to drop in a major way because so many index funds are in it and so much money from Berkshire is in it, Berkshire Hathaway, so much money of their own. Like they're just ready. They just increased their buyback by like 90 billion. So increasing that buyback by 90 billion means they can take advantage whenever their stock drops in a meaningful way. Apple's a great company. I can't hate on this. I do think he's using it as a cash park situation rather than buying something like bonds. I think he's using Apple as kind of like that bond situation. Yes, the dividend's tiny, but you're probably gonna get some price appreciation along the way. Big elephant in the room at the tip top. The weighting is 25%. 25%. A quarter of the portfolio is in Tesla stock. Man, let me get this out of the way. I am a proud Tesla shareholder. I have been talked out by family and friends. I've been talked out of selling Tesla like more than 10 times, probably 20 or 30 times. I've been like, dude, oh God, I'm gonna dump my Tesla shares. This stock is way overvalued. It's run way too much. And they were like, no. Hold on to the stock. Here's why. And everyone who gives me their bull thesis around Tesla has motivated me to hold that stock. I've held it for many years. I haven't sold a share in many years. I also haven't bought a share in many years. So I'm just holding. I'm a happy holder of Tesla. I just like to see the drama and the silliness. Yes, that means my portfolio goes up and down in value pretty substantially whenever Elon Musk makes a stupid tweet, or whenever Tesla has great earnings, or whenever they do these big price cuts. It's a big drama show over at Tesla. But that said, 25% of the portfolio is excessive. You could do this with any stock. If Apple was up at the 25% area, it's pretty high at 15.5. But if Apple was up at 25%, I would be saying the same thing. This seems a little bit excessive, kind of putting all your eggs in one basket type thing. What happens if Tesla gets cut in half? That means you go from 25% down to 12.5% of your holdings. That means your 5.27 million that you have in Tesla in this ETF would drop into the 2.6. That would be absolutely tragic. It just seems like an unnecessary amount of risk I don't think there's gonna be all that much upside in Tesla over the next 5 years. It had run so much over 2020, 2021, 2022, And then we started to see a big crash, 2022, end of 2022, beginning of 2023. We saw a big rise again, but man, it's just a big drama show. I wouldn't put all my eggs in one basket. Yes, Tesla's a great company. Yes, they've proven themselves quarter in, quarter out over the last 9, 12, 15 quarters over and over and over again. They're a beast. They're a growth beast. It's about to be a EPS beast as well over time, but still 25% seems like a little bit ridiculous. A lot of eggs in one basket. That said, you have to define your own risk appetite in the stock market. It seems like Meet Kevin is totally happy with the risk that Tesla holds as it relates to having 25% of his portfolio in it. He's very bullish on Tesla. He does a lot of research on Tesla. He feels extremely confident that Tesla is not going to go down in a meaningful way, and it has a high amount of upside moving forward over the next few years. He's probably right, but I do think Tesla could be dead money for the next few years. I could be wrong though. It could soar to the moon and double up again. I don't know, but there's only so much a stock can run. Okay, wrapping this up, on the website for the ETF, it says here, Kevin performs a company-by-company analysis of various financial factors such as price over earnings to growth, PEG ratio, revenue growth, and margin growth. It says Kevin select those innovative companies within Kevin's view above average potential returns in terms of growth across the metrics considered for inclusion in the pricing power ETF portfolio. If that's the whole thesis, I think he did a good job of picking these stocks, except for that one aerospace defense company, ERJ. I totally disagree with that pick. By a long shot, I would go with Lockheed Martin instead. That's just me. But in terms of that little paragraph right there, I think he has selected at least 9 out of the top 10, fit that in a really, really, really meaningful way. I don't think that means you have to do all of that in your top 10 though. Like you could have a smaller allocation to those and then put a little bit of safety in there. I feel like the only safety stock in there is Apple, and Apple's a big tech, and big tech's pretty drama filled, you know? So I think a little bit more safety stocks, switching ERJ out for LMT, Lockheed Martin, would be a good step. I think having something that's a little bit more inflation proof, right? It's like something like Costco or something like that would be good as well. Adding Costco to this list would make this absolute beast portfolio, and maybe lowering the percentage of Tesla. That's just my opinion, but I can't argue with any of the readings on his, methodology of choosing these innovative companies with pricing power. I can't disagree with it. So based on his risk appetite, clearly it's pretty high, but he's picked some good companies here. I just don't understand the tons of semiconductor stocks all in the top 10. I don't really understand having 25% into Tesla and 15% into Apple. It seems like a cash park to me. If you just split that 15% into Apple, instead of 15%, do 7% into Apple, 7% into something like Costco. I think that'd be a great switch there. And then of course, like I said, switching out ERJ for Lockheed Martin. All right, that's all I got for today. If you are buying this ETF, let me know. I will not be buying this ETF personally. Hope you enjoyed the video. Let me know your thoughts on the Meet Kevin PP portfolio below, and I hope you have a great day. Bye-bye.